Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert, Abel Pacheco. Now, Abel is the founder of 5T CRE, a multifamily investment firm focused on opportunities and growth markets. Abel got to start back in 2008 and has since invested in more than $100 million of assets. In addition to his investment activities, Abel is also a podcast host and a commercial loan broker. And so, guys, with that, I'd like to welcome Abel to the show. How you doing, my friend?
Hey, I'm doing great. Thank you very much for having me.
Yeah,
Appreciate it, brother.
excited to have you here. As we were talking before we got rolling here, you got a lot of things going, lots of activity as we, near the end of the year here. And so I'm excited to chat with you about just all the different things that you've got your hands in, Abel. But before we dive deep into it, maybe just take a few moments. I'll kind of give the mic back to you, and you tell our listeners a little bit more about yourself, who you are, how ultimately how you found your way into the space.
Yeah, absolutely. Thanks for having us. And again, my name is Abel Pacheco. I'm the president and principal of Five Talents Capital. So ultimately, man, we're buying deals. Commercial multifamily properties is really where we spend the majority of our time, really investing in today. And we try to buy deals in South Texas. And I guess no mystery there. I live in San Antonio, Texas, so we try to invest, where we live, right? And the Alamo City is where we spend most of our time, and Texas born and bred, so it's hard not to invest here. Man, for years, myself and my wife were basically investing all of our time, effort, and energy in work. We were tech employees, tech people. I was a sales guy for years and years and years, and my wife was a tech person as well. And so she was customer service, customer support, and throughout, from 2006 ish to about 2018, we would take every dollar that we had from our W-2 gig, and we bought a bunch of single family houses. So it took us like 10 years to buy 10 properties. And then all of a sudden, in a couple of years, we go from 10 doors to 1,000 plus. And that was the multifamily essentially light bulb that goes off. And we did it passively as passive investors first. And we moved, basically all of our 401ks. We went all in, removed it all, and kind of got invested passively before we realized, oh, it's pretty cool. Checking it out. I want to be a general partner. How do I go learn more? And in the last several years now, we've been full-time commercial real estate. We just gone to every freaking education course, every class, every mentor group, every group we could possibly join, flew all the way around the country, 200 plus hours of like coursework, many thousands of dollars invested in education, and then just, slowly but surely getting active and executing on the education. So that's been us, right? So that's a little bit of our background. I have a 3-year-old and a 5-year-old, and my little ones take up the majority of my time outside of real estate. Before them, I used to hunt. I used to do some Wing Chun Kung Fu. I used to have extracurriculars, and now it's like the kids. So that's basically where I work, which is real estate, and the kids, and enjoying life, man. I'm husband, father. I serve as a deacon at my church here in San Antonio, and just loving life, man. That's us.
That's awesome. Good deal. I appreciate that, and I want to make sure we don't gloss over really the what I would say would be the probably two pivotal moments maybe throughout your real estate journey. The first was when you and your wife identified that that ultimately you guys need to be parking your hard-earned money, way back when you're looking to buy that first investment property, into something maybe outside of traditional stock market or other types of investments. And so talk to me about that moment. Like, what was the light bulb way back then that said, hey, we need to buy a piece of rental real estate? And then ultimately you realize that first one went pretty well. Let's buy a second, third, fourth. And like, you guys went through a period where you built a decent little portfolio. I mean, like that's very impressive. That's way more than 99.9% of the population ever does, right? So, but what was that really that first light bulb moment that really it pushed you guys to take every hard-earned dollar that you had of savings, instead of blowing it on a new car, luxurious vacations, that you guys actually put it into rental real estate?
Well, I wish I could say it was one pivotal moment, but it was a series of events really as I was a young kid. I mean, my dad was the first person that had taught me about real estate investing. So when I was little, before technology, before, easy PayPal, payments or rent payments, things like that, my dad would take me to our first rental property. It was like a two-bedroom home that the five of us lived in when we were little, and when he moved out to a second house, he kept the first one and kept it as a rental. So on Saturdays, I guess once a month, we'd go out and we collect a rent check. So when I was a little kid, that's what I remember, knocking on the door, being amenable, saying hello, how's everything going, checking out the house. And then on the way to the house, we'd go get like a McDonald's burger and French fries or something. And so I had this association like, this is cool. I like rentals. We can now go buy my burger and fries as a treat with my dad, and that was a cool Saturday afternoon, Um, that stuck, throughout the years, and I didn't really realize it stuck till looking back now. But then it was a book that a lot of us probably talk about as the real estate investing, Purple and Yellow book, Rich Dad Poor Dad,
Yep.
was, I was working full time. I was a commission only guy for years and years and years. I sold Cutco knives when I was younger, and we did in college, uh, 18 to 25. We sold Cutco. It's like literally kitchen cutlery, did in-home presentations,
I did
would
it
get
too.
referrals and yeah,
Yeah.
say that again.
I said I did it too for a period of time, a couple of
I
years.
love it, man. The Cutco guys. So that commission only kind of got me prepared for, got to work hard, got to grind. If I don't do something today, then I'm not going to have a check for tomorrow. So it's kind of already that little bit of a risk there. And when I moved over to my tech world, I realized the same 50% of my commission as a sales guy or 50% of my pay was commission. So if I didn't sell something, then 50% of my pay was not there. So it was
Mhm.
still a bit of a risk. So I think inherently I was always kind of built in with I'm ready to take a risk to get a bigger payout. And so it just easily transitioned to I'm willing to take a risk if I can forego buying the new car, buying an expensive watch, if I can figure out how to live below my means, then I can take an extra 15, 20, 25 grand to another deal. And that's what we bought. We would buy one house, live in it. We'd move out, followed my dad's old model, move out and rent out the first one and buy the next one. And we did that over and over and over again. And it was just that little bit of a mental exercise, mental hurdle, mental obstacle that I had to overcome to be able to sign on the first loan. Even the first house was like it's $115,000 way back in the day. And in that I was like, this is a big chunk. I don't know if I can afford to do it. And let's take a little risk. I'm gonna make a commission payment. Let's do that. The second one was the same feeling of, oh man, now I'm gonna have two payments. So every time I did another deal or bought another rental, it kind of stretches your mental capability for
Yeah.
the ability to take a risk on the next one, to sign another loan, to kind of get out there. And that was a amalgamation of all these moments that said, you know what, I think we could try to go bigger. And there's a lot to unpack there, but that's what we did over and over and over again.
Okay. No, and I appreciate that. At some point, your wife, she had to get fed up with you moving every year, right? With the next property, right? Especially when she had kids. I'm sure that she's like, okay, no more. We're not moving
No
again.
more. We're real people. That was the most fun part of it. It was like, oh man, we the first time we packed ourselves, the second time we found somebody, there was a mover. He still moves us to this day. He's probably had 7 or 8 of these moves, and he just made it a lot easier. But yeah, every time it's a challenge. It's a work. It's got to move from one house to the other, and that whole thing was a grind. And there's a lot in there, and
Yeah.
it got worse when a renter destroyed one of your houses, and you're like,
Oh
it's a
yeah.
$30,000 chunk that I was not expecting. Kind of eats
Hmm.
up into your passive lifestyle and passive income, and you realize oh, it's not so passive anymore. But we did it, so that was a good 10 years.
Okay, so that was the first light bulb. Then the next light bulb was the multifamily light bulb. Talk to me about that. Just what brought it to your attention? Just the idea of multiple
Yeah.
units, large scale multiple units underneath one roof. What brought that to your attention?
Well, it was the first deal that we did was 100 and first deal we did was passive investing. And I think that passive investing, that was the real pivotal light bulb moment to commercial because I didn't have the knowledge or education for the commercial real estate world. But what I realized was I was putting 25, 30 grand into every new rental property we were buying. And then on the back end, I was taking care of these big major items that needed to be fixed. A roof, an interior, renovation, complete rehab, a big AC or something. So I got more comfortable with this $50,000 amount, which is a typical minimum on a lot of these investments. So I said, well, if there's 50K and a way for my money to ride in a bigger deal, a chance for a little bit more reliability, safety, the opportunity to be passive, truly not find the deal, not call it, talk to a renter, not deal with the contractor, not deal with the headache of going by. That was the big aha moment to commercial. So we ended up, being passive investors in our first 800 to 1,000 doors. We took all of our money out of 401k and deployed it in. We took all of our liquid capital and really learned through the process. And then what we learned was, man, there's a safety in numbers, bigger deals. There's a greater chance that we're going to have more success, and a lower chance, that one renter is going to ruin a deal, which happens in single family a lot.
Yeah.
So I think that was a big moment to overcome a lot of really my own limiting beliefs, like that Abel Pacheco, you can go do bigger deals. And when I was younger, I just didn't believe that. I didn't know that I could, or I didn't have the ability. We were not wealthy family, either my parents, us. It just wasn't even in my thought process that we could have bought a first 124 units, $7 million deal when we did our first general partner deal. And it was the passive investments that kind of laid that foundation or groundwork to be able to say, yeah, you could do it. Everybody else does it. Why not you?
No, I love it. I love it. I mean, it's amazing when you start thinking about the limiting beliefs that we all have, because, let's looking back at before you start buying these bigger units, right? Like you basically bought a home every year for 10 years and you had a portfolio of 10 single family properties. That literally still puts you in the top 99% or the top 1%, right? And because I guarantee there is plenty of people that maybe you went to school with, or that lived in one of the neighborhoods you lived in, that ultimately are like, well, I mean, I can't even fathom what he and his wife are doing. Like that is absolutely insanity to me. Like they can't even think that big. Once you have one or two houses, they can't think that big, right? And then then like we have these limiting beliefs of these larger scale commercial deals, and then ultimately you get in there and you realize that it's just there's some additional nuances there, but ultimately it's all achievable. And as you continue progressing down the road, like you start looking at even bigger deals, right? $100 million deals. It's really it's all part of the same ball game. It's just, a different inning, really, more than anything else. And no, that's awesome. I appreciate you sharing that. That's incredibly helpful, especially for those that are just getting started out. Talk to me about, you started by making LP investments in these bigger deals, getting comfortable with identifying the right sponsor. I think that's another, we have a lot of active folks that listen to the show, a lot of passive, some are crossed over, right? They do a little bit of both. And, I think one of the most important elements, being on the LP side, is being able to pick the right jockey, right? And identify the right sponsor that's got the track record experience. Cause now, there's a lot of options out there, especially if you spend any time on social media or Facebook. I mean, your feeds, filled with different 506c opportunities to invest in, and ultimately, one can spend quite a bit of money and make the marketing look really, really well, but you really have to understand what's behind the curtains. And so talk about how you guys were able to evaluate and identify that quality sponsor in the first couple of deals you did.
Yeah, well, I tell our investors today, the big areas are deal, market, team, right? So when we were investigating, our first deal versus the way we do it today, very different. But the deal, has to make sense. The market has to be one that I want to be in, and the team, as you mentioned, has to have a successful track record. And the way I went into my first deal was I lived in the market, San Antonio, so I kind of felt comfortable with it. I had invested all the 10 houses in there. The deal, I didn't know how to underwrite. I didn't know how to look at assumptions. I didn't know how to do any of the background and track record review of a sponsor team. I trusted the sponsor. I mean, that was literally the way I got introduced, was somebody I knew, liked, trusted. And I'm not saying I recommend this for anyone today, but it was literally how I did. I said, man, is this a good deal? And that trust factor was, I knew that person. I went to his wedding. He grew up where I did. We worked at the same places, and I felt like he wasn't going to take my money. And when you're talking about that, um, when you're talking about the pretty marketing, the assumptions, the Excel, the finance work, I think a big part of that is like, man, who is the person you're actually investing with, or the team members on it? And do you know them well enough, like them well enough, trust them enough to kind of even spend some time on it? And so what I really recommend to investors today, I still recommend deal market team. On the team aspect, it's, you got to spend some time with somebody, and that's not going to come overnight. You spend some time, likely when there's not a live deal, investigating early. You get on somebody's calendar, schedule some time, ask them about their track record, about their experiences, ask them about some of the runs that they've had, ask them about performing deals and performing, ask them, how they pivoted from one to the other. And, when you dig into that early on, you start to get a sense of like someone's, their genuine personality, their genuine responses. You start to get a feel for somebody of like, yeah, I like, know, and trust this person. I feel good about it. And when you ask their track record and you dig in, oftentimes not during a live deal is where I spend most of this time. You get a sense of like, okay, this is how they treat people. This is how they respond. This is how I'm going to interact with their team over a period of times. If you try to do some of this, I've had on the flip side, now that I'm an active operator and sponsor, where we've had a live deal and somebody's asking me for a lot of this information. And the only thing I'm concerned with today is like trying to fill up a $5 million mark in 30, 45 days. It's very hard to build trust and give somebody a lot of this information and track record, because the only thing I'm focused on is like trying to get this money today to close this deal. So if you start this process 6 months, early, 3 months, 4 months, 2 months, 1 month, 1 month comes, and then now they have a live deal. It's a lot easier to move forward on something. So, if I'm a passive investor, take your time early. Don't forget what Warren Buffett says. Good deals are like cars on a freeway. They're going to keep coming. There's more, I promise. You don't have to feel like it's your only one, do or die. There's not a stress or pressure to it. There's a lot of opportunities, and, take the time to vet someone out. I heard from I was on this other stage speaking at the Real Estate Domination. It was a Las Vegas investing event. And one of the guys talking was, they're raising capital for a fund, and their fund buys venture capital or private deals, tech companies, really startup, like on the other side of real estate investing. But their approach, their mentality made a lot of sense too. He goes, you know what? If I'm going to invest in a startup, like a pizza company, a mom and pop company versus a big chain, those are two different, vetting that I'm going to go through. But I'll tell you, the pizza chain, at least I can see data, track record, experience, very easy for me to see kind of unbiased information. Where the mom and pops, we actually may make more money with a mom and pop. If they do it right, they may give a bigger equity multiple, they can give you a bigger return, whatever it is. He goes, but if that mom and pop has only done one pizza place, and they're going to try to start their second or maybe their first, he's like, that's a very risky deal. Mom and pop, they've done it 10, 12, 13, 14, 15 times. They're trying to expand, a lot lower risk, profile. So whether it's the big entity or the small one, a lot of times it's still their track record, their performance, how they've done. And, just experience will start to tell you 8, 9, 10, 10, 11, 12, 13, 14, 15, however many deals. I mean, they've seen more obstacles. They've seen more challenges.
Yep.
Likely they've had some slip and falls as well, but they know how to get through it on the next one. And that's kind of what we're looking for as a passive investor and somebody looking to vet, others out.
No, I love that. I love that. I appreciate you sharing, and would love to chat with you about the, I guess how you guys are managing, the current market volatility. I mean, things that this been shaken up. I mean, they've been shaken up a little bit over the past, 6 to 8 months with, interest rate volatility. That's pushed some potential buyers onto the sidelines. A lot of sellers really haven't necessarily reset their expectations on pricing, and so just how are you guys managing that? Have you seen things slow down? Have you seen an uptick? What exactly are you seeing within your own business?
Yeah. Well, from the loan broker position, the data that we have is 10% of all deals in the commercial real estate space need to trade. And that's every year. So when you look at commercial loans, 3-year bridge loans, 2-year one extensions on 5-year, long commercial is 7 or 10 years. It's roughly speaking, any year, regardless of market outcome, 10% of deals need to trade every year. So there's that percentage that absolutely has to do something, whether it's refinance or sell, one of the two, something's got to happen. The way we have been working at it because we're both buyers, trying to buy anyways, as many deals as we can. And also, we're sellers. We've got a couple of deals where we're at our time, at our final all in. This is the last, time we have to extend. And, those are a year from now where we were thinking, shoot, I got to make a move today because I don't want to be caught in a position next year. So as a seller, it's an unfortunate time where if you have to sell, if you're forced to sell sooner than you want to, then man, you're subject to the current offers, which you're coming into a position where lenders LTV is typically lower today. It's December 2022, right? So Fed's moving the rates up, which is coming at bridge loan 8% if I'm going to factor in, maybe 9% in the future if I'm going to get more conservative. And we're all hoping that they kind of peak and go down, but your underwriting has to account for that increased interest rate if you're a bridge guy. And if you're a bridge guy, well, then your offers are going to come in lower for them to make it right, to make it pencil. So as a buyer, I'm looking at every deal along the same. How do I figure that part out? Or what is my fixed rate assumptions going to be if I can find stabilized properties that are willing to go? And we're also looking at assumptions. There's some deals that, a couple of years ago, they did some deals and everyone's looking at them like, why are you doing a 5.5 interest rate, fixed rate for so long? And now they're saying, exactly, I told you so. And we're looking at assuming those. So those are kind of coming in the mix as whether you're a seller, you're in one position, or you're a buyer, you're trying to evaluate that stuff. And, the deals are still, I still see offers going out on some of the properties that we have, LOIs coming in. I haven't sent a ton of LOIs out, but I'm still underwriting wherever we can. But, we're kind of maneuvering into a different angle, which is, just from multifamily acquisition to we started a couple of new development deals that we acquired some land on an owner finance, went through the entitlement process for, very long time. And then working a HUD, 221 D4 loan, which is fixed
Wow.
rate,
Those are
40
tough.
something year amortization, exact opposite, but it's, it's a deal that's 2 or 3 years in the making. It's a long go. And then we've got a build to rent that worked out really well with one of our partners, had a piece of land, started doing the development and was a single family developer for a lot of years. And it's kind of came into the commercial world and said, well, man, let's build a subdivision and treat it as a built to rent as opposed to selling single family houses, which that was the background. And so that deal is something that we're kind of maneuvering into, as well as like, well, how do we take some of that knowledge and do land entitlements, right? So there's all these things that I think an investor that's trying to figure out how to maneuver today, that, they're trying to figure out where to go, how to do it, and how to make the best of the situation that we have today. So that's what we're doing. That's what we're doing right now.
Well, super exciting. Yeah, those. It's funny. I've never been a part of a successful HUD loan, one of those 221 programs, and nor have I known anyone directly, associated with me that's actually made it all the way through. They're it's a ringer, man.
we're at a year and a half roughly with the 221 D4 loan today. in a year and a half prior from all the land stuff. So we're definitely in it. I would say that we're probably not the typical, the deal maker that usually goes through it nice and easy, clean is probably a year to a year and a half. So this being a good learning lesson for all of us. So it's been a fun journey, man.
If you can nail it, then it's a beautiful loan. I mean, like you can't beat a 40-year amortization. Just do you know where the rates are at today on a loan program such as that? They're very different than what most people are expecting. I mean, given where the
The
market's at.
Well, the LTV is high, which is kind of
Was it
it's different,
80%
right?
or
So 80 to 85% loan to value, and they'll let you carry sometimes for the right deal an extra 5% of loan to value on a line of credit. So not having to have the actual capital there, but having a bank, line of credit that says, hey, if they need extra money, here it is. So that will stretch the LTV. There's something extra for the developer called BRSPRA, builder's risk, something SPA, right?
Mhm.
That builder's risk is an extra. That BRSPRA there is an extra like 5-ish% sometimes that will be provided to the investor as equity on the line without having to put dollars in it. So it's not something we can pull out. It's not liquidity,
Yeah.
but it's extra equity that we don't have to bring to the table, which is why the loan to value can go, 80 to 85 or maybe even a little bit higher. The interest rates that they are subject to the current, right? So you still have, 5% interest, 5.5, which is, a year ago when we were starting the process, it was 2.7 as a fixed rate, which we were all licking our chops. And now it's a different time and place. But for 40-year, one of the, kind of safest vehicles when you think about HUD vetting out exactly what we're talking about, really HUD vetting out the deal, the market, and the team. So it's definitely due diligence on steroids. HUD creates the what their bond, right?
Mhm.
Uh, there as the bond gets printed, in the investors, buy this bond, and it's underwritten or backed by the deal. So HUD has to have enough confidence in the feasibility studies, the appraisals, the land, everything that you're doing, and then more importantly, the construction team. They vet out the developer, so the owner developer, the contractor, the architects that put it together, and also the property management. And those are the big four components for the HUD process. If you can put together a good team, actually like syndication, it is similar though. If you can have a strong HUD team, I'm a first time HUD developer, but it's really putting my partnership team with somebody that's done 80, 90 deals already. And that's how we're kind of getting into the game, right? So
Yep.
not for the faint of heart. You got to have the ability to go a long term, loan process and all the way through it. But if you can come out of it, the goal is 43-year amortization with the 3 years of build and, fixed interest rate, kind of the gold standard of a government backed loan, right? So
Yep.
that's the reason you have a different investor base also, which I realize some different investor base that are willing to back the deal with more larger investments because it's a HUD certified or HUD
Interesting.
stamped.
Huh. Yeah, I wouldn't have thought of that, but no, that makes sense. That makes sense. Well, good deal, Abel. So you got a lot of things going on. I appreciate you coming to the show and
Yeah.
sharing just a little bit of your background, your team, kind of how you've progressed throughout these years, and went from doing single deals to big multifamily deals. It's an amazing story. Really appreciate you coming on and sharing it. And for those that want to learn more about you and your team and the different projects you guys have working, where's the best place to track you down?
Go to our website, probably the easiest place. The number 5talents.capital. 5talents.capital. There's kind of the ebook, some videos, some education, some of our portfolio stuff, and you can set up some time via the website to book some time with us if you want to talk, and look forward to it. But Kevin, it's been awesome, man. Thank you for giving us a few minutes time, and you're an expert in your area, and many multiple new arenas that you've developed over the last few years. I've learned a ton from you, man. So it's been a pleasure just kind of being able to come on the show. And man, God bless you and everything that you guys are working on, brother.
Yeah, I appreciate that, brother. Yeah, same to you and your family, and all your future successes. So, and guys, to everyone that's tuning into this week's show, I appreciate you coming on here as well. I wouldn't be here if it wasn't for you. So, thank you, Abel. Thank you and your team. And guys, this is your host, Kevin Bupp, signing off for today, and I'll see you next week. Take care.